Good morning, everyone. We're Group 9 and we're here to report the International Financial Environment Exchange Rate. So, International Monetary System, Early System. The International Monetary System discusses, among other things, the system of exchange rate or the relationship between the value of any two currency. Gold standard is a monetary system wherein the government hold coins in reserve against the bank currency note that are in circulation. The banknotes can be exchanged for gold on demand. Bretton Woods system of exchange rate. The value of members' currency set in terms of gold or US dollar, meaning the exchange rate was fixed. Provision for adjustable pegs, meaning that the country could devalue its currency to remedy its continued balance of payments problem. Similarity as in gold exchange standard, members' currency were convertible into the US dollar and the US dollar was convertible into gold. This means that the dollar was as strong as gold. Exchange rate regime since 1973. In the wake of the collapse of the Bretton Woods exchange rate system, the IMF appointed the Committee of 20 which suggested various options for the exchange rate arrangement. The options were broadly: first is the floating independent and managed, second is the pegging of currency, third is crawling peg, and lastly the target zone arrangement. Exchange rate quotation, direct and indirect quotes. Exchange rate are quoted either directly or indirectly. A direct quote gives the home currency price of a certain quantity of foreign currency, usually 1 unit or 100 units. Buying and selling rates. Normally, two rates are published, one being the buying rate and the other being the selling rate. Buying rate is also known as the bid rate. Selling rate is known as the ask rate or offer rate. The selling rate is the rate at which the banks sell any foreign currency to their customers. Forward rates. The quotes for the forward market are also published in the newspaper and periodicals. Cross rates. One currency is sold for a common currency, and again the common currency is exchanged for the desired currency. This is known as cross rate trading. Determination of exchange rate in spot market. Process of determination. The demand for foreign currency comes from individuals and firms who have to make payments to foreigners in foreign currency, mostly on account of import of goods and services and purchase of securities. Factors influencing exchange rate. The most important factors influencing the exchange rate are flow of funds on the current and capital accounts, rate of inflation, rate of interest, and lastly, market intervention by the central bank.
The market intervention mechanism has already been discussed, so the other three factors will be discussed at some length. Flow of funds on the current and capital accounts. Current and capital accounts are the two parts of a country's balance of payment, an important macroeconomic concept relating to its international trade, while current accounts track the flow of imports and exports. Capital accounts track the flow of assets and liabilities. The sum of current and capital accounts is always zero, meaning that when a country has a deficit in its current account, it necessarily has a surplus in its capital account and vice versa. Next is impact of inflation. In an inflationary environment, unevenly rising prices inevitably reduce the purchasing power of some consumers, and this erosion of real income is the single biggest cause of inflation. Inflation can also distort purchasing power over time for recipients and payers of fixed interest rates. Inflation can be both beneficial to economic recovery and, in some cases, negative. If inflation becomes too high, the economy can suffer. Conversely, if inflation is controlled and at reasonable levels, the economy may prosper. with control, lower inflation, employment increases, is interest rate. The interest rate is the amount charged on top of the principal by a lender to a borrower for the use of assets. An interest rate also applies to the amount earned at a bank or credit union from a deposit account. Theories of exchange rate behavior. Exchange rate theories. Balance of payment theory. First, higher inflation rate differential at home, greater import and lower export, greater demand for foreign currency, depreciation of domestic currency. Second, greater real income at home, greater import, depreciation of domestic currency. Third, greater interest rate at home, inflow of foreign capital, greater supply of foreign currency, appreciation of domestic currency. Monetary approach, flexible price version. First, increase in money supply, higher price level, depreciation of domestic currency. Second, money supply being less than real domestic output, exists demand for money balances, lower domestic prices, and appreciation of domestic currency. Third, rise in interest rate, lower demand for money, and domestic currency depreciates. Next is monetary approach sticky price version. First, increase in money supply to depreciation of domestic currency. Second, increase in money supply to price rise, to lower real interest rate, to lower inflow of capital, to depreciation of domestic currency. Third is rise in interest rate to greater inflow of capital to appreciation of domestic currency. Fourth is rise in interest rate to increase in money supply to depreciation of domestic currency. Next is portfolio balance approach. Domestic income or wealth increase to greater demand of foreign financial assets to depreciation of domestic currency. Second is foreign financial. Foreign financial asset being more risky to demand for them decreases to appreciation of domestic currency. Balance of payment approach. Let us begin with the balance of payment approach. It discusses the impact of inflation, growth in real national income, and interest rate on the exchange rate. On the contrary, increase in the domestic interest rate causes greater capital inflow that increases the supply of foreign exchange and thereby causes appreciation in the value of domestic currency. The first two factors influence the current amount, while the third factor influences the capital amount. So next is monetary approach of flexible price version. The monetary approach of the flexible price version emphasized the rule of demand for money and the supply of money in determination of the exchange rate. But if the increase in money supply is lower than the increase in real domestic output, the demand for money balances and leads to a lowering of domestic prices, which causes an improvement in the value of domestic current. However, critics of this theory argue that since the purchasing power party theory is not applicable in the short run, this theory does not hold in good in the short run. Monetary approach of sticky price version. The monetary approach of the sticky price version rests on a couple of assumptions. First is that the money supply in a country is endogenous, meaning that it is positively related to the market interest rate. The second is that the PPP theory applies in the long run, and so the expected inflation differential changes have a role to play in the determination of exchange rate. The argument in favor of this approach is that an increased money supply leads to depreciation in the value of the domestic currency. On the other hand, like the flexible price version approach, an increase in the real output helps appreciate the value of the domestic currency. Is portfolio balance approach. The portfolio balance approach suggests that it is not only the monetary factors but also the holding of financial assets such as domestic and foreign bonds that influences the exchange rate. This approach suggests that the exchange rate is determined by the interaction of real income interest rates, risk, price level, and wealth. If a change takes place in these variables, the investor re-establishes a desired balance in its portfolio. The re-establishment of the portfolio balance needs some adjustments which, in turn, influence the demand for foreign assets. The portfolio balance approach is more comprehensive but exchange rate forecasting. Relevance of exchange rate forecast. Forecast is required in order to decide whether to go or hedging or not, while making short-term investments of cash for making long-term investments for raising funds and for assessment of earnings. Second, problems in exchange rate forecast. There are of course some problems in exchange rate forecasting. First of all, the majority of forecasting techniques assume that the past economic data would be a guide for the future. Secondly, the forecast normally concern the nominal exchange rate changes. But if a country is constantly facing a high rate of inflation, the real rate of exchange moves far away from the nominal. Thirdly, forecast of cases generally provides exposure management advice on a currency by currency basis. Techniques of forecasting. The forecasting techniques can be grouped under four heads. They are technical forecasting. Technical forecasting is concerned with the investigation of new trends, radically new technologies, and new forces which could arise from the interplay of factors such as new public concerns, national policies, and scientific discoveries. Next is fundamental forecasting. Fundamental forecasting is a currency forecasting technique that uses fundamental relationship between economic variables and exchange rates. The economic variables used include inflation rates, national income growth, changes in money supply, and other such macroeconomic variables. Next, market-based forecasting. A market-based forecasting uses market indicators for forecast exchange rates based on the concept that these market indicators efficiently incorporate expected future currency changes. And lastly is mixed forecasting. Mixed forecasting is when a company uses more than one forecasting method to come up with prediction of the company's future. Analysts often work together and can use multiple methods to increase accuracy. Last is forecast error. Forecast error is disparity between actual and forecast exchange rate divided by actual exchange rate.
12. International financial market. 12.1 Foreign exchange market. 12.1 Distinct futures. It is the timing of the actual delivery for foreign exchange that differentiate between spot markets and forward market transactions. In the spot market, currency are traded for the immediate delivery at the rate exciting on the day of transactions. In forward markets, currency are delivered on the future date at a rate mentioned in the contract. Broken date contract is not a full month forward contract. 12.1.2 Major participants. The participants in the foreign exchange market are individuals, firms, banks, and government, and occasionally international agency. Individuals are normally tourists who exchange currency. The other tier constant of constructions between two banks. It is the second tier of the markets that accounts for the largest segment of the total foreign exchange transactions in the market. Again, the participant may be grouped also according to their behavior and their motive behind foreign exchange transactions. They are 1. Non-banking entities that simply exchange currency in order to honor their obligations or to get the desired currency. Second, non-banking entities such as traders that use the foreign exchange market for the purpose of hedging their foreign exchange exposures on account of change in the exchange rate. They are known as hedgers. Hedging is discussed in Chapter 20. 3. Banks that exchange currency on behalf of their customers. In such cases, their profits is limited to the amount of spread between the bid and the ask rates. 4. Aggregators who exchange currency because of varying rates of exchange in different markets. The varying rates are the source of their profits. 5. Speculators who buy or sell currency when they expect movement in the exchange rate in a particular directions. The movement or of exchange rate in the desired directions given them profits. 12.1.3 Currency arbitrage in spot markets refers to making profit by buying a currency cheap in one market and selling it there in the other markets at a particular point of time. 12.1.3 Speculations in forward market feels that the future spot rate of a currency will be higher than the forward rate. He will buy the currency forward on the majority date. He will get the currency cheaper at the forward rate and immediately thereafter he will sell a currency in the open market at the higher rate, thereby making a profit. On the majority date, he will make a profit equal to the difference between the forward rates and the spot rates. However, if the exchange rate moves the other ways, the speculator will have to bear losses. 12.2 Market for derivatives. 12.2.1 Market for currency futures. Currency futures markets refers to organized foreign exchange market where a fixed amount of a currency is exchanged on fixed majority rates in the spot. Market to market or marketing to market refers to comparing today's exchange rates with yesterday's till majority and transferring the profits or loss to a margins any account create for this purpose. 12.2.2 Market for currency options. A currency options contract is similar as a forward contract or a futures contract in the sense that the buyers of currency options possess the right to buy or selling foreign currency after the lapse of a specified periods of a rates determined on the day the contract is made. But the currency options contract has a distinctive figures that is not found in a forward or a futures contract. Types of currency option forward refers to market for the exchange of currency where the option buyer enjoy the leverage or not exercising the options if the rate is not variable. Next type of options contract. Broadly speaking, there are two types of options. In a called options, the buyer of the options agrees to buy the underlying currency, while in a put options contract, the buyers of the options agrees to sell the underlying currency. In call options, the option buyer contract to buy the underlying currency In put options, the options buying contract to sell the underlying currency. In recent years, some more variants of options have been available. The first is known as a forward diversing options. In these cases, the call options premium is paid only when the spot rate is below a specific level. The second type is preference options. In the case, the buyer gets an additional privilege to designate the options either as a call options or as a put options. In case of average rate options, it is the arithmetic average of the spot rate during the life of the options that is taken into account instead of the spot rate on the majority. A look-back options provides the holders the rights of purchase or selling foreign currency at the most favorable exchange rates ng realized over the life of the options. Options terminology. For a clear understanding of the currency options, readers must be acquainted with a few terms that are used in the content. Often, buyers is a person of a frame who holds the rights to buy options. If the options buyer agrees to buy an underlying currency, he is the buyers of a call options. Option seller is the party that is obligate to perform if the options is exercised. He is the party who charge a premium to granting such as privilege to the buyer. Exercise price is the price at which options are exercised. It is also known as the strike price. At the money is the situations when the strike price is equal to the spot price on the majority rate or date. In the many positions occur when the spot rate favors the options buyer. It is when spot rate, strike rate in a call, and when spot rates, strike rates in a put. Out of the money is just the opposite of in the money. Premium is the sum of the options instinctive values and the times value. Distinct values denotes an extent to which an options would currently buy profitable to exercise. 12.3 International Financial Markets. International financial markets. A. Official sources. Or number 1, multilateral agency. So, ang duha ka parts of multilateral agency is international development banks such as the World Bank, IFC, and others nga mga multilateral agency. The second, regional development banks such as Asian Development Bank and others. 2. Bilateral agency or different governmental agency. B. Non-governmental agency is number 1 ng growing the lending markets involving international banks. 2. Security markets. Era siya sang 2 parts or 2 kinds sang security markets is deep security kag equities. 12.3.1 Multilateral agency. Up to the 1940s, there was no multilateral agency to provide funds. It was only in 1945 that the International Bank of Reconstruction and Development or IBRD was established. So, ang bilateral agency naman, the history of bilateral lending is not older than that or multilateral lending. During the first half of the 20th century, funds flowed from the empire to its colonies for meeting a part of the valedictory defeats of the colonial government. But it was not a normal practice, nor was it ever considered as external assistance as it is on the present day content. Bilateral economic assistance was announced for the first time by the U.S. President Truman in January 1951. 12.3.3 International banks. Among the non-official funding agency, International Bank occupy the top positions if one looks at their development since 1950s. Distinct structural change are evident. Eurobank in the late 1950s and especially in the early 1960s, bank with a purely international characters emerged on the global financial map. Factors behind the emergence of the Eurobank, there were a host of factors leading to the emergence and growth of Eurobank. 1. Dollar deposit on London and other European country-based bank came to be known as Eurodollar. Bank accepting such deposits come to be known as Eurobanks. Second, restrictions on the use of the funds sterling, the external transactions in the wake of the foreign exchange crisis of 1955 to 1957. The emergency of Eurobanks was supported by some capital controls measures by the US government in the wake of its balance to payment crisis in the 1960s. Four, some of the European governments puts restrictions on holding the deposits by non-residents in domestic currency and on paying to or on to paying of interest or non-residents deposits. 5. The interest rate ceiling was exposed by the US government too. It means that when credit was tight and the market interest rates had risen, the US bank could not raise interest rate. 6. When domestic credit has distracted companies borrowed from Euro banks normally at lower rates of interest. Increased lending and deposits contribute to the growth of Euro banks. It was not only that the US bank came to be based in Europe. Next, syndicate lending. A syndicate loan is a sustainably or substantially loan provided to a large borrow, 1 million or more, by several lendings together. 12.3.4 International Security Market. So may anong nga parts ang international security market? This is number 1, shift toward security market. 2, international equities. 3rd, international bonds. 4th, euro notes. 5th, euro commercial paper or ECP. And the last, medium terms euro notes. Shift toward security markets. There was a big lift in a bank lending during the 1960s and more particularly during 1970s after International Bank had acquired the surplus or oil exporting countries. But during the 1980s is a number of factors emerged on the map of international economics that led to a shift from bank lending to growing securitizations in the international financial market. Next, the international equities. Euro equities are not dips as holders are paid divided. They do not present of the FDI as the holders do not enjoy voting rights. They represent a mixture of the two and hence are in a great demand. Number 1, they are issued when the domestic market is already flooded with shares and the issuing company should not like to add further stress to the domestic stock or shares since such additional may cause in a flow in share prices. 2, company issue such share for gaining international recognitions. 3rd, such issue bring in the squared foreign exchange. 4th, capital is available at lower or lowest cost. And the last, 5 funds raise the ways do not add to foreign exchange explores or exposure. International bonds may take any forms. They may need to be foreign bonds or euro bonds. A bonds issued in a foreign country financial markets and denominated in the currency of the country is known as foreign bond. But a euro bonds being issued in a foreign country and dominate any country's currency other than the currency of the country where it in issue. Then sa euro notes or promissory notes is by issue by company for a raising short term funds. Ang sa ECP is promissory notes like to euro notes. It is not written and also it is issued only by highly credit or creditworthy borrowers.